Hi, everyone. We're going to wait for everyone to join. We'll allow a few minutes. Thanks for joining us. Okay, I guess we can slowly begin. Thank you all for joining. We're excited to welcome you to our live webinar titled How to Prepare Your Agency for a Strategic M&A Exit. For those of you who don't know about Productive, Productive is an end-to-end tool for running a profitable agency. So within Productive, you can run everything that your agency business may need, from sales, project management, resource planning, task management, budgeting, and clearly financials and invoicing. However, in this session, we will not be talking so much about agency management, but about agency evaluations, buying and selling agencies. So I'd like to welcome our guests and our speakers, Michael Seidler, CEO and founder of Madison Alley, and Tomislav Car, CEO of Productive. Today, we're going to actually focus on a couple of things. So what we'll cover is a brief history of Madison Alley. We'll talk about the $1 trillion market that are agency M&As. And we'll go through the drivers of premium valuation for agencies, as well as typical deal structures and multiples. So without further ado, let me hand over the imaginary microphone to Tom.
All right. Thank you, MK. Thanks everybody for joining us, and thank Michael. My name is Tomislav, Tom. Actually used to run a digital product agency for 15, 16 years, grew that to about 300 people, and now I run Productive, and we build the software that MK was explaining before. So, but yeah, I want to welcome our guest, Michael. Hey there, Michael.
Hey, Tom. How you doing?
Yeah, it's going great. So yeah, can you tell us a little bit more about Madison Alley? Basically, what do you do? How do you got into it? You've been doing that for like, what, 20 years, something like that?
Yeah. So first of all, thanks very much for having us. Really, excited to have this conversation and also to hear any questions from the guests. So Madison Alley is a strategic M&A and capital advisory firm. We are exclusively focused on the digital marketing, media, and advertising, technology, data, and service ecosystem. And we're actually the first M&A advisory group specifically focused in this sector. So we're founded back in 2003, and for the last 20 years have been focusing on strategic M&A in this sector. Personally, I was used to run the global investment group for Interpublic. So have really followed and focused on the sector for about 25 years or so. We're based in New York, and we have significant presence in the Silicon Valley area, and we have clients globally. And as you'll see, it's a global market, so a lot of our strategic buyers are global. We're led by former strategic buyers and investors and global operators, global agency operators. And so we have a lot of experience in the space. And so these are just a sample of some of the deals. Probably the most kind of landmark deal about 6 years ago, we had advised Heat on its sale to Deloitte Digital. So this was literally the first agency acquired by any of the global consultancies, what they called the world's first.
I remember that. That was kind of like everybody was in the agency space. Everybody was talking like, what's happening now? Are these like big consulting companies going to eat us up? That was the story.
That's right. Yeah. So Accenture in particular has really, in fact, been the most acquisitive buyer in recent years. So we can talk about that and what they're building. But you can see some of these others. We've also advised like Jam3, merged it with MediaMonks and S4 Capital, was run by Sir Martin Sorrell, and then like Jump 450, which is a digital performance marketing group, algorithmic driven and data driven, that is bought by Omnicom Media Group. So that's just a sample of some.
Like characterize, these are all like service companies. They are not like product companies. Or are they like partially product, partially service?
That's right. So we focus on both agencies, consultancies, meaning service deals, and then professional services, as well as the marketing and advertising technology. So, for example, like a key is delivers advertising technology. Has technology to deliver ads, impression-based and moment-based ads, and particularly in the retail media space. So that's an example of kind of ad technology. But these others here are examples of agencies and consultancies.
Okay, yeah, understood. So it's mostly services, but also products that are in the advertising space, I would say.
That's right. Yeah. So marketing SaaS, like SaaS marketing software, advertising technology, and then agencies and consultancies.
Gotcha. Okay, cool. What's kind of like one of the biggest, if you can talk about it, like one of the biggest?
Sure. So last year we sold the company Theorem so we merged it also with MediaMonks and S4 Capital. To give you, the deal size wasn't, but they were doing about 60 million in revenue or so, and the EBITDA is it wasn't disclosed, but let's just say that we do deals anywhere from kind of 25 million on the small end to, let's say, $400 million. So that tends to be the sweet spot.
Gotcha. Okay. Yeah. So I think that's kind of gives us a little sense like where you're at and like what do you do, and that you're kind of really specialized in this type of market we're talking about. Now,
that's right.
About
And so the clients themselves on the kind of agency or the service side, they tend to be in terms of like 5 million of EBITDA, maybe a little bit less, maybe 4 million, up to about 30 million of EBITDA. And then in terms of net revenue, anywhere from kind of 15 or 20 million in net revenue up to maybe 80 to 100 million of net revenue.
Gotcha. And like when we talk about M&A, there's always like a buy and a sell side. So a buyer and a seller, and companies like yours, they work with like both sides. So typically, but what do you like? Do you just do buy or sell side advisory? What do you do?
Yeah, that's a good question. So we're experienced as actually former strategic buyers and investors. So we actually come from the buy side, and we think about things in terms of strategic corporate development. So for anyone that's running, whether it be an agency or a tech company, you're not necessarily thinking, am I on the sell side or on the buy side? You're thinking, how can I ultimately maximize and optimize the full value of the business? And so that may be, in some cases, depending on your size, you may be considering buying something, you may be considering maybe raising some capital, and ultimately selling. But the transactions themselves are both buy side and sell side. So we do work both on the sell side and buy side. We do more sell side work than buy side, but we do also work with strategic buyers and actually particularly recently, maybe it's because the market has moved a little bit, but working with strategic acquirers to help them really expand upon their business and to develop and what we say realize premium value. So there are certainly cases that we work with either strategic buyers in their acquisitions and help them to find acquisitions, or even institutional investors like private equity groups that are either wanting to establish a new platform or their portfolio company wants to make acquisitions.
Right. I think we'll talk a bit more about that. Like you say platform, what does actually platform mean?
Yeah.
So a lot of people on this call, like some are maybe thinking about it. A lot of people don't actually think about selling their agency until that moment comes. So some of this terminology we need to probably always clarify what we're talking about. But the market, you mentioned the market. So if we talk about the market in general, like how do you see the market today? I mean, what do you see happening?
Yeah, sure. So it might be, so if this is really, kind of gives us a macro view of the market. So the real, interesting, insight that we've discovered, or that is kind of prevalent in the market is, I grew up, at Interpublic. And so there was a time where the top 4 or 5 holding companies acquired everything. And so the view of the world from that lens was that really these holding companies kind of dominate the market.
When we say holding companies, that will be Interpublic, WPP, Omnicom.
That's right. So Interpublic, Omnicom, Publicis, Havas is smaller, but still Dentsu in Japan. So those are the top, let's say, 5 or so holding companies, and they own lots of global agencies like WPP, as most people know, own like Ogilvy Mather and others, or Ogilvy now. Interpublic owns McCann and other large global agencies. So those are, the kind of the ad, what are considered the ad holding companies. You also have the consultancies, the global consultancies. So these are groups like Accenture and Deloitte, and others like Capgemini and Cognizant. And then there's been a whole wave of groups that have come, particularly from India, but also from other places, like Wipro and Infosys and Tech Mahindra and some others. So Tata is another one. So those are what we would consider kind of generically global consultancies. And then you have, private equity groups that have portfolio companies within the sector.
How would you compare, let's say, you mentioned Infosys or Wipro to like Omnicom? Like, is that like comparable in a sense, or?
Right. So what this slide represents is, on the far left, you have really the creative marketing and media services. And these are mostly the ad holding companies. And then on the right side, you have the tech consultancies, which have a lot more IT services. So there's a great convergence where, groups like Accenture in particular, but also Infosys and others are acquiring more to get closer to the center, to offer more marketing services, or digital marketing services. And in some cases, what they'll say is to establish credibility with the chief marketing officer, with the CMO. And then on the other side, you have the marketing service, or ad holding companies, which are acquiring and increasingly acquiring, to the right, more tech services. So an example is actually, S4 Capital, which acquired Theorem One. Theorem One is a custom software development consultancy. And so that adds those kind of tech service capabilities to Media Monks, which is, as most people know, is really premium content and much more, creative services. So that's an example of how they're moving closer to the middle.
Basically, it's kind of converging. So we have the tech companies want to be more creative, and the creative companies want to get more tech, right?
That's right. And so one of the actual central points of where is a lot of that kind of the glue, or the kind of where is the movement, is the tech services recognize that, in particular, they need to establish better like UI and UX and customer experience interfaces on top of all the software that they're building. And that kind of moves them into more of the creative services. And then obviously the marketing service groups, have realized, in groups like RGA or Huge or, whoever else, have been, building the applications themselves in addition to the customer experience. So it's really the customer experience, which is the central focal point of all, of the whole convergence, that now, global, service providers recognize that they need to build customer experiences. And that is both from the strategy and the creative, from the top end and the creative, through the UI, UX, and then all the custom software development, or the commerce platforms and the content platforms on the tech side.
Gotcha. So, and then this is kind of like what's happening on the left and the right of this quadrant, but what's happening top down, like
That's right. So, and also, just to give everyone kind of perspective, this is sort of the interesting thing, that if you add up the top 7 or top 8, 10, even 10 holding companies, you're going to get below $100 billion of market cap. And then if you look at Accenture alone, like here, it's about $175 billion. So Accenture alone is close to 2 times the size of all the 10 holding companies combined. So that just kind of gives you a magnitude of how the holding companies compare to the global consultancies. And that's just Accenture itself. That doesn't include Deloitte and PwC, IBM, which itself has over $100 billion market cap, Tata over $100 billion, Infosys almost $100 billion. So you have really $1 trillion plus market value market, of which the ad and marketing service, the holding co's only really represent at best 10% of that market. So there's actually a huge potential value, and that's what's really and so there's a lot of value for them to acquire into the tech services. Now, at the same time, as you said, there's a huge amount of capital from the global consultancies to acquire more user experience and design, more creative services, more customer experience capabilities. And so if you're an agency, if you're a digital marketing agency, or, and so you can help any of these global consultancies move from building software and development to more user experience and customer experiences, then, that's really, there's a huge wave of capital, $1 trillion of capital, that's, or at least, an M&A fraction of that, coming towards acquiring companies in this space.
Of course. I mean, it always depends on like what somebody wants. Like, is that the strategic direction you see your company in? But I understand what you want to say here.
Exactly.
Okay, so I mean, this kind of like it's a huge market, and there's a lot of these different players and stuff going on there. But in terms of like when you actually get to this point, or like how does your company become interesting? What drives these like valuation? I think at one point, like everybody's interested. I remember when I was still kind of running an agency, I didn't mean to sell it, but I was always interested. How is this thing that I've built,
Sure.
How much is it worth? You want kind of, it's like an achievement at least.
Yes.
So can we talk a little bit more about that? Like, what are the drivers of the valuation agencies?
Yeah. So to your point, so if you think about the global consultancies as an example, there's these windows that exist where they want to increase their capabilities, and particularly they need to move and evolve to have more credibility with the chief marketing officer and be able to build really, top to bottom, customer experiences, right? So the things that are important to them are things like strategy, customer experience, UX, innovation, or what's called, like full stack innovation, and then there's obviously bleeding edge kind of capabilities like AR, VR, augmented reality and virtual reality. There's also a lot of commerce development, particularly over the pandemic. There was, a clear necessity to the digital transformation, and that digital transformation of large global enterprises, requires commerce platforms. So these are things like Magento or Commerce Cloud and others. Data analytics is always in, there's always a scarcity of that, and there's always a great demand for data analytics capabilities.
Like, what are these tiers? Like, what would you say? What are these tiers on this slide?
Sure. So we'll get into, so these are kind of a relative valuation, and also interest level from strategic buyers, and we'll get into what the valuations look like. But basically, we just, the market it's a private market, so it's not scientific. There's no real science to it, but on a relative basis, what we've done is categorize tier 1, 2, and tier 3 capabilities. The top ones are the ones that are in the highest demand and which the valuations, the highest valuation will be paid on. And then you get to things that are a bit more commoditized, like content and creative, and then web design and development, because these things have been being done for the last 15, 20 years. Even search and paid search, it's become a bit more commoditized, and so or email or display ads, so that becomes lower on a valuation size. And then you see in terms of size, there's some, we have tier 1, 2, and 3 tiers in terms of how the size of the business and the scale of the both revenue and EBITDA, net revenue and EBITDA, how that affects valuation.
Right. I mean, this size is mostly gauged at like US businesses. So
yes.
Businesses in different areas of the world have different, I'd say, revenue profiles, but do you see the multipliers being different or what do you think about the geography in this kind of equation?
Yeah, that's a good question. So I would say that both the capabilities and size apply to really any business anywhere. And these are kind of relative impact on the valuation. Geography is a good question. And so there is a relative impact Whereas, for the most part, US based businesses, or like New York, it's particularly if you're in a center. So it's not just US, but if you're in New York or, San Francisco or London, or a main, a main market, then the valuations tend to be higher. Where if you're in a second or third tier market, they tend to be lower. Now, this is less the case now because there's so much remote work, particularly since, the COVID started. So geography matters less than it used to. But, to some extent, that does matter.
Right.
The clients do matter. So for the most part, I would say that the most valued clients tend to be US market clients. So that the revenue now probably matters more than, where the headquarters is, and where
the clients, the geography of the clients, not of the actual.
That's right. The source of the revenue. That's right. Exactly.
And so do you think like some of the things on this, it's interesting for me, like you say, web design and development has been, for a while, they've been here for a while, and you said it's kind of commoditized. Do you see it happening because of like advancements in also technology, maybe like things like Webflow and, stuff that's showing up?
Yes, so some of it is just a function of time and the development and the evolution of the capabilities, but also there's it's obviously to the point that there's a lot of offshore capabilities, whether they be in Eastern Europe or India or Latin America, and so the models themselves have been changing, and there's been also an evolution of more evolved models where revenue may be sourced in the US or in Western European markets, but the actual development and work is coming from Eastern Europe, from India, from Latin America, or wherever else. So those tend to actually be pretty good models because they're scalable, and so that is helpful. But if you look at for the most part, aside from maybe strategy, which has been around for a while, people will always pay up for, pay multiples for really strategic thinking, and for real, deep data analytics and that kind of insight. But, a lot of the tier one capabilities tend to be more advanced, current, like AR, VR, where there's less people that are as innovative and have kind of those cutting edge capabilities.
Right. Okay. Understood. So maybe we could jump to the next thing. So so we talked about the drivers of the valuation, basically the answer to the question, how do I make my agency more valuable in terms of capabilities, so what you need to work on, and the revenue. But like, well, from a KPI standpoint, from a metric standpoint, we'll talk about this a little bit later, but we're productive. Basically, this is like also the main three things that we see are the most important things. So growth in terms of revenue, margins. I think always in this line of valuation, and you correct me obviously if I'm wrong, we talk about EBITDA margins and EBITDA, like it's all at the end measured by EBITDA, and client concentration. So for anybody that's not kind of aware, client concentration is basically the metric of how much your, let's say, first or second, third, or like let's say your top three biggest clients, how much percent of the revenue do they actually have associated with them. So can you comment on this a little bit?
Sure, of course. Yeah. So this is great. So other things beyond the kind of the business itself, or the capabilities and the size. So growth matters. What most of the activity tends to be with businesses that are growing at least really 15% per annum, and obviously anything higher than that, 20% more is great growth. And so that will also, the margins will the multiples will appreciate to the extent that the growth goes beyond 15-20%. There are acquisitions of companies less than 15%, but for the most part, that's really where kind of an attractive threshold, if not really 20% plus. The margins, is usually looked at as profit margins of either EBITDA margins or profit before tax or something like that, or EBIT. But what tends to be preferred is at least 15% is the usual threshold, and as you get closer to 20%, that's 20% is usually considered a solid business, and then anything above 20% is really a very well-run business. So we see but I would say if you're at kind of I would for the most part try to get to 17, 18, if not 20%. And if you can get above 20%, then you're running efficiently. If you're below 15%, then I would look at where your cost structure and see what you can do to get beyond, especially beyond the 15%.
Yeah,
In
but
terms of client,
just if I can just jump in on this stuff, what I'm basically kind of seeing, talking to people and in general, is the feeling that geography wise, the margins you're talking about are like US based usually. Like in other parts of the world, companies might have lower margins, but then they have the other problem, which is what you said, their revenue is not appreciated as much as the US based businesses. And typically smaller companies have like higher EBITDA margins. So they might even, like in the beginning, 20 people, they might have like 35, 40%. And then as the company grows, you basically can't keep that, level of margin. And as it becomes bigger and bigger, it basically, normalizes at the numbers you were talking about, like 20%, basically.
That's right. Yeah. And we do see like tech service businesses where the margins may be 12 or 13%. But for the most part, I think if you look at where most of the acquisitions are being made and where the interest is, for the most part, 15% is, tends to be a good place in terms of margin. That's a typical threshold. And then many of the groups will really prefer to buy something that's 17, 18%, if not 20% plus.
And the client concentration, what do you think about that?
Yeah, sure. So client concentration is as you said, the percentage of revenue of your top first client, if not second or third client, as a percentage of net revenue. So if you think about the first client, there's different spectrums of what is preferred or allowable. Many like private equity groups, some will say we don't want any clients greater than 20%. But the reality is that we've done lots of deals with companies with concentration as high as even 45% or even 50 to 60%. But for the most part, I would say that to the extent that you can keep your largest client below, let's say 25% or below 30%, then that would be ideal. And then now there's a flip side, because there is a benefit to having larger clients where you have, your large, that you can demonstrate that you have clients that are above 500,000 per year or above $1 million a year, clients. So it is helpful to have clients that are above $1 million, a year accounts. So you have to sort of balance that with not having one client that is, ideally not more than 25 or 30%.
What do you think? You say that they basically say that they don't want to look at if it's over 20%, but at the end, they still do the deal. What do you think is the reason?
Well, so it depends also, and there's other, who is the largest client also matters. So if your largest account is, Google or Apple or Amazon or Microsoft or whatever else, of really prominent stature, then that's helpful as opposed to, a client that no one is, as excited about. So that does matter. The other thing that matters is the tenure of how long you've had that client. If it's been for 2 or 3 or 4 or 5 years, the longer the better. And then also, what's your strategic relationship with that account? So it's different if you're working with a global CMO or CEO where you have lots of relationships at the strategic level. And so to the extent that you're talking about your business, that's helpful, the nature of your relationships. The other thing is what people will look at is like Google, for example, and Microsoft, there's lots of operating units. So you may be working with, Xbox on one side and then, other Microsoft units. And so to some extent, there's sort of a breakdown.
Basically? Can you expand on the, right?
Right. And also from a risk standpoint, is your risk kind of diversified among different operating units?
Okay. Yeah. And I think also maybe it matters on who's the buyer, basically. So if the buyer, you call them strategic buyers, if they see an opportunity to, let's say, upsell some of their existing capabilities to these like large clients across these different divisions or something like that.
That's right. Yeah. And so actually a lot of acquisitions are made where, a buyer will look at your clients and then see how well it maps to their existing clients. So if you also have a large client that they share, then for the most part, they're always trying to increase their market share within their large clients. Now, obviously, it does help to have some new clients that they don't have or new verticals that they may or may not have. But for the most part, most buyers tend to appreciate when you have clients that are aligned with their clients, because they can build market share within their client base.
Right. Makes sense. Okay. So, I mean, in general, when we talk about drivers, these are like the main ones. but there are also a couple of other things that could be interesting. So
yeah, and also one of the things that actually relates to productive in particular is the scalability of the business. So to the extent that the business is running efficiently and is scalable and is, whether it be technology and process and procedures. So that's actually, so having a platform and a tool like, productive that is in place, or other technologies that enable the business to be not just of scale, but scalable, then that's, something that's of great value to buyers, because ultimately they're not just buying you for where you are now, but what's your future potential and how well you can scale as a business.
Right. Yeah, I've also seen that happening. So that's a good comment.
Yeah.
Okay.
So
Go.
So this is as we think about how do you ultimately realize premium value and premium strategic value, you see some deals where there's the multiples are far in excess from typical deals. And so we've asked and looked at, are there commonalities among some of these deals of which kind of sets the conditions for a company to be acquired for great value. So an example,
apart from the previous stuff we talked about, the actual numbers, what are the other things that make the deal happen?
That's right. So what are the kind of underlying value, not just value components, but really drivers of great value? Like, why would a buyer pay what might be considered irrational prices, but far in excess of typical market? And so I'll give you some examples. When we sold Heat to Deloitte in 2016, Deloitte was building a global marketing consultancy. And so they had, let's call it a $500 million, a plan to build a $500 million global marketing consultancy. So at the time, when they looked at Heat, that was their studio platform. You asked about a platform. That was the agency that they were going to replicate. They're going to replicate the brand and the capabilities throughout the US and internationally, which they've been doing. So in that case, they're looking to build a $500 million global business, and Heat is the platform. They're willing to pay more because they're buying it with the, in their mind, what's the magnitude of what they're building into far exceeds the multiples. They're not buying it for a multiple of the EBITDA, right? So that's an example of an ambitious, target for a strategic platform. It's also, high strategic priority to acquire certain capabilities. So if a buyer is not just buying more capabilities, what they already have, or just buying another geography of things that they already have, where they're entering a new market, or really using this as a platform to scale upon, they'll pay a lot more for that kind of capability or platform. So now what's also interesting is, you think like, am I the market leader? You don't have to be the market leader. From a buyer's standpoint, they go across and they see what are their best options. And so really what matters more is how you stand out relative to the other options that the buyer has. And there's lots of reasons why other options may not be good options. They may be larger and they may even be better than your agency, but maybe the CEO is difficult to deal with, or maybe there's other institutional investors and other dynamics at play, or maybe the CEO or founder doesn't want to stay for long, and so or maybe there's high concentration or whatever it is. So from a buyer's standpoint, and it's helpful to think about it from a seller's standpoint, to get as best a view as you can of how important is this, how much of a strategic priority is this for the buyer, how much of a priority is, how committed are they to buy into this space, and then ultimately, what are their options? So if you have any sense of what other options they have, that tends to be very helpful. You also see, buyers when they have a lot of surplus cash, that's helpful, obviously, or if they have an inflated share price, because if they are trading at a very high multiple themselves, then they could pay a much higher multiple, what's called an accretive deal, still lower multiple than theirs. And so they'll buy you at whatever, 8x, if they're trading at 15x, that arbitrage, gets absorbed into their market, and so that they directly benefit from that deal.
Do you think that's kind of, I mean, we can talk about this later also, but maybe it's a good time. The general economy right now, the recession, and the general stock market, obviously. How does this have you seen it influencing the decisions?
Sure. I think what we've seen is there's, as you can see from the universe, there's a very diversified set of buyers now, and there's a tremendous amount of capital and market capital. So if you think about a lot of these deals, which are in, call it the 25 million to really, sub $200 million valuation range, and in fact, some are kind of 25 to $100 million. Really, the vast majority of the acquisitions are done. So relative to their market cap, they're still relatively small investments. But that said, the market is, shifted where there's, a bit less, appetite for risk. And so buyers are taking a bit longer. They're being more selective. There's a little bit less of it, but still there's so much that they need to evolve into building full stack customer experiences that there's still a lot of acquisition activity and a lot of interest. So what I would suggest is, so long as your business is being built and it's growing well and profitable, there will be plenty of buyers and plenty of different options. So I would, kind of look more at that. There has been some adjustment, which we could get into I think as we look at the valuations themselves, we can talk about how much the market has impacted. Okay.
Yeah, that would be great for later. Okay, and I think the last topic was just the pressure. If you go back one slide,
yeah,
the pressure to accelerate growth.
Yeah, sure. So, I always, like one example was like, many years ago, like Dentsu, for example, they were mostly in Japan or all in Japan, and they were getting a lot of pressure. They had a lot of cash and they had a lot of pressure to move into new markets and to find new markets. And so that sort of investor, pressure was, they ended up acquiring a business in the US and North America, and since have really expanded and been very acquisitive to build all of, not only Dentsu Americas, but even in Europe, and really expand. So that's an example where that matters. Obviously, if competitive pressure. So a lot of the impetus to provide digital capabilities, better customer experience. It may even be to be able to have capabilities in kind of social platforms. So to the extent that a large agency doesn't have data analytics capabilities or social media capabilities or whatever it is, and they're losing business or they've just lost to a competitor, that will put a high strategic priority on them to go out and buy something to fill in, because they're losing to competitors.
Gotcha. Okay, cool. Moving on. I think the kind of last big topic we talk about is the deal structures. So how do these deals basically look like? And it's always the same story, right? It's always the story of, you're probably selling your agency once in your life, or maybe twice. And the other side, this is like the 20th acquisition they've made, and they have the best advisors, they have everything. So, these types of things are very useful to people who might be interested in selling, to kind of get more insight into the whole process, right?
That's right. So, if you think about kind of three main types of buyers, and there's kind of maybe two. Private equity has kind of two types. But the global consultancies, which we talked about, so these are the Accentures, the Deloitte, and then even the Wipro, Infosys, and all those. So they tend to acquire and try to integrate the businesses. And so they tend to be more revenue focused and retention of the individual, of the team themselves. So you see that there's, in some cases, revenue. In most cases, these deals are still done on a multiple of either EBITDA or EBIT or some profit metric. There's very few deals that now are being acquired as a multiple of revenue. But what you'll see is that the consultancies will pay more upfront, anywhere from 70 to 90% upfront, and then the earnout will be anywhere from, it's actually 2 to 4 years, just depending on because they want to integrate it sooner. And so the issue with many of the earnouts is, when you acquire a business, the business needs to remain independent, because you have to measure it on an independent basis. And so while that's helpful to kind of mitigate your risk, the challenge to that is that you can't integrate as soon as you like. And so
so just in terms, if somebody doesn't know what's an earnout, can you kind of explain that?
So an earnout means, like, we'll use the agency holding company. So this is like an Interpublic, WPP, Omnicom, and really even marketing services groups, in general, they'll buy a business and they'll pay maybe 40 to 50, 55% upfront of the total value. And then over the next, call it 2 to 5 years, the business will be measured as their average either EBITDA or EBIT over that period. And so after each of those years, there's a payment of a multiple on their profit, either for that year, or like after year 2, it may be an average of year 1 and 2. And after year 3, it may be an average of year 1, 2, and 3. The average of that, the profit of that times a multiple. So that's, what an earnout is.
And so basically what you want to say is if you have an earnout, you won't integrate the company
Right.
Integrate it from a corporate structure or integrate it like from a brand perspective, probably.
That's right.
And then you want it. So it depends on what you want. Basically, do you want to integrate it sooner or later? That's how these things work.
So historically, groups like WBP and Omnicom and Interpublic and Publicis, they would acquire businesses. They still do a lot of this, where they'll acquire a business and there'll be an earnout for really 5 years or so, 4 or 5 years. And so that business needs to remain independent. Like you said, the brand, the operations, the P&L is all independent from whatever it's being acquired by. And so you really can't integrate with the rest of the business because it needs to remain independent and being measured for that, during that time period. If you look at private equity groups, they're in a much shorter time period to consolidate entities and to sell and to resell and exit. So
private equity, their main, like the agency holding companies, they just want to be bigger and bigger and bigger. But the private equity, they have some sort of exit in mind, right?
That's right. So they're acquiring and investing in what we'll call like a new investment platform, which just means an agency that they believe can grow organically and that they can acquire and build it. And then ultimately they're going to exit in 3 to 5 years. So they're on a much shorter window and time horizon, whereas a lot of the holding companies or public companies, they're not exiting anywhere, or the global consultancies. So the private equity groups need to integrate much faster, and so they don't typically have earnouts, or they're very, very short earnouts. And so you see the structures different for the private equity groups. They'll buy 51 to 85% of cash up front at a multiple, and then that remainder is either equity in the business that they're investing in, or equity in the portfolio company that is of theirs that is acquiring your business.
Right. And I mean, I'm guessing because, the multiples, so private equity, you put down like 7 to 9x of EBITDA, which is like, and then let's say the agency holding companies, it's 10 to 14. And the global consulting is 8 to 12. But like, obviously the top ones are higher and the private equity is lower.
That's right.
This is kind of backed by the whole story that there's no earnout process. Right?
That's right. So ironically, the holding companies, the deals can be the highest ultimate multiple at the time that you sell. And that's because there's a lot more risk being borne by the seller, especially of a 3 or 4 or 5 year earnout. You're taking the risk and being paid on the risk. So the multiple actually can be higher, whereas the global consultancies will play much more cash up front. And the earnouts are, kind of 2 to 3 or 4 years. So there's less risk, but more cash up front. The private equity deals, you're paid, pretty high cash up front, 51 to 85% or so. And then there's also what they call the second bite of the apple, where the equity that you're, as the business is then sold again, or the buyer is sold, you can then benefit from the accretion, the increase in value of the equity that you're receiving.
Right. How do you see the size of the actual businesses impacting these multiples?
Right, sure. So this is these multiples for the most part pertain to companies, as you see the footnote, between kind of 20 to 75 million of net revenue, between like 5 to 15 million of EBITDA. And this is for the most part, let's say, a U.S. market. So we were talking before about, how does geography matter? How do other things matter? So, that's where, so these are for the most part, and there's some ranges in here. So the higher end of the range will be towards the tier 1 capabilities, towards the tier 1, geography. And then the tier 3 will be at the lower end of these multiples. So on a relative basis, as you look at like emerging markets, those will tend to be at the lower end of these multiples. And then, in the higher tier markets, like New York or San Francisco or something like that, or London, that will tend to be at the higher end of these multiples.
Right. Yeah. Okay. So I think we have a lot of actual questions. So
And not just
we-
geography, obviously growth and other things will all client concentration. So all these kind of variables come into play, and that's where kind of the range comes into, where you land.
Okay.
So thanks, Michael and Tom. It's time to now switch to the Q&A part. We have quite a number of questions. We don't have that much time to answer all of them, but let's go through some. So one of the first questions was, what advice would you give to someone if they want to build their agency with the mind of selling it?
Right.
Sure. Yes. So, well, I think for one, think about obviously what you're building and how distinct it is of what you're building. And so look at these kind of capabilities or look at other things and say, are you offering the similar services as kind of traditional marketing services, or are you gonna, do you want to be more specialized? And so, I think that helps to think about distinction and building something that's there's less of. I think it depends. You can see here that at certain threshold, the business can be sold. So as you get over kind of 3-4 million of EBITDA, and that's where you start to enter into the universe of the acquisition activity. If you have the patience, you can continue to do it organically. If you want to do things quicker, then look at combinations of other businesses that you know well or that you think would be good combinations, and that you may want to combine with. But just keep in mind, anytime you do a merger, there's complications, and it's not as easy as it may seem.
Yeah, I would maybe jump into that and just say, I remember I listened to a talk from James of Two Bulls, and he sold his agency, and he was talking about the whole experience of going through it. And one of the things he did say was, he wanted to sell the agency. So then he realized he needed to, do all these things to organize it, set up systems, set up EBITDA, kind of make it better. And
Sure.
then at the end, he didn't sell it. He wound up selling it 2 years later. But the whole process of just made him build a better agency. So I guess the reverse also works. If you just want to kind of sell it, you need to make it, really efficient. You need to make it not all about you. You need to make it just at the end, provide something of value, and that will be sellable to an extent.
Yeah, absolutely. So it's helpful to have, good financial controls, that, and you're reporting on an accrual basis, not on a cash basis, that you're, have, that you organize. It is helpful to get an advisor in as early as possible, because just getting the insight will help you to think about and prepare what are the key metrics and how can you, build the business and really position it well. So that tends to be helpful. So any advisors that you can get, even legal advisors, that you can get as soon as possible, tends to be helpful. Whether you engage them formally or not, it's just helpful to talk to people that have experience in, M&A transactions. The sooner the better.
Sure. Second question, maybe for Tom. How big does an agency have to be in order to start thinking about possibly selling your business?
Yeah, sure. Yeah.
You can go ahead, Michael, as you wish.
So yeah, it tends to be the acquisition activity probably begins at kind of 3 million of EBITDA or so, and closer to maybe 10 to 15 million of net revenue, and then it grows, and then private equity groups, if they're investing in a new platform, and a lot of the buyers will tend to look for things that are 5 million plus of EBITDA. And usually that's about 20 million in net revenue or more. There is acquisition activity below that from kind of 2.5 million to 5 million of EBITDA. And so, for example, if a private equity group owns a portfolio company, owns an agency themselves, or service group, they may be acquiring something of that kind of smaller scale. So if you're in that kind of 2.5 to 5 million of EBITDA range, then there's still opportunities within that tier of like private equity owned companies. But if you want to get into the full universe of selling to holding companies and consultancies and be a new platform for a private equity group, that tends to happen in kind of the $5 to $25 million EBITDA range.
Yeah, I just wanted to add that, I mean, I've seen, like even really, really smaller shops do this, but they're like not on this map. They're not on like what you're talking about, the really big players. They're more like there's not a market for that. It's more like people know people, something like that happens. So I mean, acquisitions I think happen in the entire spectrum, but the structured way of happening is like in the larger part, the lower end is not that structured, but it's still happening.
Exactly right. And so there may be more stock components to the smaller deals, but it's just a function of you need a buy. If you want to get paid with cash, then you need a buyer that obviously has enough cash to pay out deals like this.
Okay.
We have another question regarding, well, it's kind of similar to what we said about, having processes set up and everything. How can I start the valuation process for my agency? What kind of documentation do I need?
Sure. So in terms of, it helps to hire an advisor who can, perform evaluation and really do a full review of the business and then give you a valuation assessment of where the business is. Ideally, someone in this space who understands the sector and understands the value of the business itself. There are some that perform valuations, but they may have less experience in this particular industry and sector and understand all the dynamics at play. So I think that's a good probably a good place to start.
Mm-hmm. Another question, how much does a percentage of turnover that is retainer-based income affect the acquisition price?
That's retainer-based, right? So that's what we would typically call like recurring revenue, and that's a good question. Most agencies operate on a project basis or a time and materials basis, and so that's fine, and that's common. But to the extent that you have retainer-based revenue and recurring revenue and predictable revenue, that is very helpful, and because it creates more stability into the valuation of business. Now, there are other ways if you have more project-based revenue to assure buyers or potential buyers of the stability of the business, and that's the tenure of your client relationships, the relationships, the strategic relationships that you have within those clients. If you have larger clients and larger global prominent clients, that is important also. So those are some of the things, but all things being equal, it's helpful to have more retainer-based recurring revenue, committed revenue, and obviously longer term clients that have been grown over time, that grow over time.
Sure. Another one, are there M&A firms out there that entertain deals for agencies that are generating less than 1 million in revenue?
Yes. It's a little bit different because they're kind of treated like as a sort of a broker or kind of a list. And so, it's a less of a personalized approach to finding the right alignment, because an acquisition is it's like a marriage, so it's a really important strategic alignment to the extent that you're not just selling your business and walking away. And most often there's earnouts and there's performance-based elements after the deal, and there's also your whole team. So if you really care about your team, then it tends to be helpful to have someone involved. There are individuals also that might work on smaller deals with M&A experience, so that might be a good option as well, for smaller entities. The other thing I would just think about is in terms of acquisitions, there's kind of 3 dimensions to an acquisition to think about. So one is, what is the strategic value that both parties are getting from it? The second is, what are the financial terms that you're getting, and obviously you want to optimize that. And then the third is, what is the personal dynamic, and so how is it going to affect you personally as a founder, CEO, and the rest of your team, and how is the culture and compatibility going to be, and what's your life going to be like after a deal?
Yeah,
sure.
I mean, we're mostly talking about like money and markets and dollars, but at the end of the day, you have to live with this. So, I mean, that's
yeah, and that's a really important thing, because most founders have been running the business and operating as entrepreneurs for a certain amount of time, and so to consider to yourself, you're now going to be part of a very different entity, and you're going to be subject to that environment and that those procedures and policies. And so ask yourself, how comfortable are you, and where is it that you really want to be in and live in beyond just the financial terms of the deal.
And you're going to have a boss. which you didn't have until now.
Exactly.
Okay, we're gonna wrap up with one final question. This one can be for Tom, if you feel. So what would be the top 3 or 5 metrics or KPIs startup agency founders should focus on?
So I think like utilization rates are, we're talking about like just general KPIs, numbers, utilization rates, the average rate. So like the average utilization rate, as in how much % of your team is utilized on client work, average rates, as in average billable rates, profitability per client or per project. So like the EBITDA, you can look at it like from, is my entire company profitable? But that doesn't really help you in detecting like which client is profitable and which is not, and even like detecting that in real time. So profitability per client, I would say revenue growth, these types of client concentration, and like all of these metrics, you know, looking at them just historically, but also forecasted. So any of these metrics you can get out of your system, or if you use Productive, you can get these metrics forecasted. So how does this look like for the future, right? So, you know, basically these are kind of the most important things, if you ask me.
Okay, we're running out of time, so I'm just gonna quickly wrap up. Thank you all for your questions. Unfortunately, there are just too many to answer all of them, but you can always reach out to us and we'll try to answer your questions. We would like to wrap up by showing you a new project of ours that we've just launched. It's basically a tool. The agency valuation calculator is you can access it by this link. I'll paste it into the chat. So using this tool, you can get an estimate of the value of your agency within 5 to 10 minutes. Granted that you know some key key metrics or revenue and EBITDA. Basically, yeah, you have to know your agency to fill this out. Alongside the general notion of the value of your business, it will give you a detailed report on the different things we talked about in this webinar. Just like growth, client concentration, et cetera, and how they influence your overall valuation. I mean, keep in mind that this tool is in beta and it's in still like the first phase of testing. So feel free to give us your feedback and test it out. I'm gonna have the link pasted into the chat right now. But the goal of this tool is only to scratch the surface, basically, of understanding valuations. And for any further steps, you should always talk to professionals such as Michael and his team from Madison Alley, who you can reach out to via their website. I want to thank you all for joining, and thanks a lot, Michael and Tom. If you're interested in trying Productive to manage your agency, you can reach out to us for a demo, and thanks, and you'll get this recording within the next couple of days.
Thanks. Bye, everybody.
Thanks so much.
Bye-bye.